Okay, and we are live. So hello again, and thanks everyone for registering for this. This is one of the biggest audiences that we've ever had from a Red Cloud webinar. So welcome. My name is Kobe Kushner. I'm a mining analyst here at Red Cloud, and today we're going to be talking about lithium. And with us today is Chris Dornbos, President and CEO and founder of E3 Lithium. Before he takes the reins, I'm going to give a little bit of an intro here. So E3 Lithium is focused on advancing lithium brines in Alberta's oil fields. Lithium enrichment in these brines has been known for decades, but it is yet to be commercially extracted. The reason is because traditional brine operations, like what we see in South America, rely on evaporation. And evaporation requires 1, the right weather, that is a hot and arid climate, and 2, the grade. Typically, only higher grades will work down in South America, generally above 300 milligrams per liter. Any lower than that, we're waiting significantly longer for the sun to do its work to leave behind a high enough grade concentrate in a process that already takes months. Alberta is not a desert, and the grades there are much lower, and so evaporation simply won't work as well. And this is where DLE, or direct lithium extraction, comes into play. The process can take minutes, not months. The footprint is relatively tiny. Recoveries are a lot higher, and importantly, it can potentially be used to tap into Alberta's brines. This really shifts the focus of what we should be looking out for when investing in these lithium petrobrine companies. As we explained in our last podcast episode, grade tends to be secondary. What matters more is deliverability of your wells and the effectiveness of your DLE. And in our view, E3 is both. It's unique in the sense that it's both a lithium resource developer, but also a DLE technology company. And their DLE could really become game-changing here, as it could allow them to tap into their 24.3 million ton LCE resource, which is the largest 43101 compliant lithium resource ever published to our knowledge. The PEA, which is based on just the Clearwater area, used less than 2% of this total resource to generate post-tax NPV in excess of $1 billion. And this was based on a 20,000 ton per year scenario. Our view is that this production rate does not do E3 justice. The real long-term prize here is scale up. Chris in the past has hinted at potential for 150,000 tons a year. And to give you an idea of just how disruptive this could be, that's about half of Australia's current output, or a quarter of the global lithium production. So we've got this massive resource, one of the biggest in the world. We have the DLE technology in the works. We have a prime location for liquid resource extraction, and a new backer, a tiny little oil company known as Imperial, that is helping to advance E3's ongoing pilot studies. And there's plenty of room to re-rate here when you consider where its peers are trading at. So during today's webinar, Chris is going to provide us with an overview and an outlook. And when he's done the presentation, we'll move on to the Q&A session. Just a reminder that you could type your questions into the comment box at any time. And before we get there, we do have to run through the fine print as always. During this webinar, forward-looking statements may be made. I would direct listeners to the forward-looking statements outlined on the company's corporate deck, which we will see momentarily. And for Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located at redcloudresearch.com for specific disclosures on E3 Lithium. And with that, I will now turn it over to you, Chris.
Excellent. Thanks for having me on here today, guys. And the perfectly dressed gentleman that you see before you sharing the same shirt was not planned. We just have impeccable taste. So my name is Chris Dornbos. I'm the CEO of E3 Lithium. We were here today to talk to you about a lot of the updates that we've had. So we've been on this platform before. We've been a publicly traded company for over 5 years. I know a lot of the people who have joined this are long-term shareholders. And so very excited to take those people through the update. And then for those who are new to the story, to give you the sort of one-on-one on what E3 Lithium is all about. So focused on unlocking Alberta's lithium resources. As Kobe mentioned, significant value here to be made by doing so. We also have a forward-looking statement. You can have a read at this. It's on our website at the deck as well, so you can have a look online. to read through that. So our goal here at E3 is to be a global leader in responsibly sourced lithium. And I'm going to show you today why I think that is a reasonable goal for us. Obviously, a large part of what we are developing is towards the global transition to electrification. And what we really mean by that is that the market for lithium is driven by the lithium ion battery. By 2030, over 90% of lithium in the world will be consumed into lithium ion batteries. And lithium is a special commodity for lots of reasons. And I'll talk about that a little bit as well, just to give a bit of an overview. So as Kobe mentioned, and we have this right up front because I think it's a pretty important move. It's something that has been worked on in the background for several years now, is this agreement with Imperial Oil. So Imperial Oil is one of Canada's largest oil and gas companies, owned 70% by ExxonMobil. So it's effectively ExxonMobil's arm in Canada, subsidiary in Canada. And they provided an equity investment of $5 million and some technical support to develop this aquifer. And just to give you an idea why Imperial, in 1947, this company discovered these reef complexes in Alberta at a famous well here called Leduc No. 1, which is what the aquifer is named after. And it started quite literally the oil rush into Alberta. When the aquifer was discovered, the Leduc aquifer, it was only about a couple of percent oil. The majority of what was in this aquifer was lithium-enriched brine. Now, they've been producing oil since the 40s, and an area that we're focused on and where the agreement focuses on is since the 60s. So they have a huge history, a high level of understanding technically about this aquifer, specifically this aquifer. They moved off of it in the 90s because it dropped below their economic threshold for oil. It's been in small and small companies' hands. The oil production is depleted now to bare minimums. So now what you're seeing is Imperial Exxon come back into this same aquifer that they discovered, but to develop it for lithium with E3. And one of the big pieces and one of the reasons that we are really excited to have this deal completed is that it consolidates a land position. So they had freehold land in the area. That is a historic piece of ground that Exxon and Imperial have held since the 40s. And so we've got an option now on that land, that freehold land, and it consolidates mainly the Clearwater project area, which is our focal point and has been obviously since the PA was released. So we're very excited about this collaboration. We're working with their technical teams now. My technical team and their technical teams are working together to advance the project. So looking at this from what E3 offers, we have obviously this resource based on the Leduc aquifer. As Kobe mentioned, 23.4 million tons was announced as an increase, and I have a slide on that. One of the world's largest lithium resources. It is absolutely massive. E3 has also developed a proprietary technology that enables us to extract lithium from the brines, and doing so very quickly, very low energy. And I think that's very important. Piece of this is the simplicity of the design of our ion exchange process. And I'll have a bit of a talk about that as well. So looking at where some of the other fundamental pieces of E3. So we've got about $20 million in the bank right now. So we're very well capitalized. We are going to be, in my mind, one of the few companies right now, in the world of lithium, no company produces a battery-grade product at the back of the process facility. It always gets shipped to a secondary refiner or converter where it's converted into a battery-quality product. And E3 plans to make that product battery-grade at the back of our facility. In fact, we plan to produce products for the battery industry at large. So that, first of all, we're looking at a hydroxide because that is the big demand in North America. These high nickel cathode batteries require higher temperatures to manufacture, and therefore they require lithium hydroxide. But we plan to offer a suite of products into the battery market as we grow and as we increase our production. And that includes things like metal. And that's why the fundamental reason why we're working with a great company called Pure Lithium. And I'll talk more about that as well. So another big piece of this is that we operate in Alberta like an oil and gas company does in conventional oil. And I'll talk about that. I think it's a really important distinguisher for things like permitting. which is what the industry is now seeing is going to be a big hurdle to get new lithium supply into the market. As these projects get closer and closer to production, the permitting hurdle becomes a very real issue. And I think that we have a strong regulatory regime here that should enable us to move through that process pretty streamlined. Obviously, the team is incredibly important, and we've been developing this team really over the last 18 months. We've been hiring, building a sophisticated group of people who understand how to build projects in Alberta. Everyone at the company has been hired from Alberta's workforce. And this is what I mean by operating like an oil and gas company. We have the talent pool here locally that know how to build this project. The only person who was not hired locally was Jonathan Nielsen. We brought him in from the States. He's our director of technology. Talking a little bit about the market, I'm sure that a lot of people on here follow the lithium market. They see a lot of the stories. They hear stories about electric vehicles and lithium-ion batteries. So just to summarize it into what's actually happened. Over the past couple of years, two big catalysts in my mind. One is that the lithium-ion battery is now the battery of choice. It's the platform that everyone is betting on for electrification. And you're seeing gigafactories being built all over the world, and every single one of those factories is built on the lithium-ion battery. So when you look at these demand projections, they're really based not so much on the electric vehicle, but on the amount of gigafactories that are going to be in operation in the future, and how much lithium they're going to need to build the batteries that they're planning to build. So, and when you look at the demand side as well on the electric vehicle part, every OEM in the world, every major OEM in the world has committed to electrifying its fleet, at least in part, if not in whole. And they consume a huge amount of batteries into those cars. So the combination of the two has driven the construction of these gigafactories, but also the demand for lithium itself to these levels that you see on this slide. This is just hydroxide. This is not the full market, right? And the hydroxide market alone is over 1.5 million tons by 2030. And a big piece of that movement and why lithium stands out more than some of the other metals in these batteries is because all of the supply required to meet that demand needs to be built new. And that's different than the nickel market or the graphite market, where you can take pieces of a very big, robust market and bring supply from that and bring it into the battery world. Lithium doesn't exist. It was never a commodity that was required in the quantities that it is today, and going to be more especially in the future. So that sort of fundamental fact is driving projects needing to get into operations. So capital is required, and the industry knows that capital is required to get these projects running. So E3 has been one of those companies, I think, and I'm very proud of this because I did found this company in 2016 that commits to doing things and then follows through and gets them done. So we have a very strong track record of success. I won't go through this in too much detail, but it is here for you guys to reference. We're very excited about all of our successes to date, but the big milestones that we need to accomplish are happening right now. And I think I'm even more excited about that's happening. So just a bit of a brief on the economics of the project. This is a year and a half old now. This is our PEA that we put out on the Clearwater project. As Colby mentioned, this is a snapshot. So this is 20,000 tons a year for 20 years. So it's a very, very small portion of our aquifer. This is 400,000 tons of production. Our aquifer in the Bashaw district alone is 23 million tons. So there is a huge opportunity for E3 to expand and grow this to a world-class producer. And we think that a reasonable amount, and this is a projection, so this is not, there's no definitive reports that outline this, but a projection of where we think the brine production could grow towards and support, therefore, production of lithium into battery products is about 200,000 to 100,000 tons a year for 50 years, or 400,000 tons a year for 25 years. We think that is a reasonable, if not slightly conservative, estimate of where we can grow our operation to. The largest lithium producer on the planet is Albemarle. They make 80,000 tons, a little bit over 80,000 tons a year. They're worth $23 billion US. So it should, when you look at that from a value perspective, it puts E3, I think, into a class of its own as we grow. Obviously, the first bit of lithium is the hardest to make, and that's, the focus right now is to get the first 20,000 ton-ish plant up and running. And I'll talk to you about our plans to do that. But that is obviously the first one's the hardest. After that, you can expand and grow quite rapidly. So looking at how this sort of builds out as an operation, I did mention that we operate like conventional oil, and how that works is that we have a series of wells that are drilled into this deep aquifer. It's about 2,500 meters down. We pump a bunch of brine from that aquifer to the surface. We bring it to our facility where we extract the lithium out using our ion exchange process. And I'll talk to you about that in the next slide. As soon as the brine goes through that tank, it goes right back into the aquifer. So very minimal handling. The residence time of this brine from subsurface through the system and back into the subsurface is probably less than an hour. In our DLE system, we make a lithium concentrate. We then refine that lithium concentrate into a high purity for lithium. So we send it through a series of cleanup stages, and then it gets into the electrolysis unit where it's electrolyzed into lithium hydroxide, and then we crystallize it into a salt. And that salt is selling right now on the spot market for $70,000 per ton. And looking at what that does to the economics, I just want to point this out. So we did our PA at $14,000 per ton, provided an NPV of $1.1 billion. Right now, the spot market is $70,000 per ton. And you're looking at our peers in the space that are on long-term offtake contracts, selling on a long-term contract basis, $22,000 to $25,000 per ton. So the market for this is growing steadily. And the economics for us obviously are very strong at $14,000 per ton. You can only imagine what they are at the $20,000 to $25,000 per ton. So looking at the direct lithium extraction, so this phrase has been used across the market now, and it's sort of a bit overused. A lot of companies are using it when they don't necessarily have direct extraction processes. So we're trying to change the name a little bit and be more specific about what we're up to. And in the future, and in not that distant future, we plan to have a report out to the market. We're just going to publish on the 101 on an ion exchange for lithium process. So we use ion exchange, and that is a clear differentiator. In my mind, the ion exchange processes are the ones that are going to be working commercially. And the reason for that is that they can achieve high flow rates, and they're very low energy. And the combination of the two means that you can capitalize on that and make an economic project worthwhile. So how this works is that it's a column, and you fill it full of beads. The beads are what's proprietary to E3. So we have spent the past 5 years developing these little beads that when lithium molecules interact with them, they stick on them. And so how this works, so you have a tank full of these beads, the brine flows through the beads, and the lithium molecules in the brine interact with those beads and stick to them. So by the time the brine reaches the bottom of the tank, there's no more lithium in it, or 95% recovery, and then it goes into the ground. So very, very minimal handling, very low energy. The energy required is to manufacture the sorbent and to pump the brine to the top of the tank. So very passive system. We then, every so often the beads fill up with lithium, so then we stop the flow of brine. We wash it off with a wash agent that makes a lithium concentrate, and that rejuvenates the beads as well, so we're able to cycle them again and bring brine back through them to strip the lithium off. We have chosen this system and the sorbent that we've manufactured because of the selectivity and the reactivity to lithium. We're able to make the material in larger sizes. And that means that we're able to use conventional flow columns. And conventional flow columns are probably the most simple processing piece of equipment you can build. And for that reason, the complexity of this is very simple. So we're able to scale very simply as well, because one tank will have a capacity, one column will have a capacity to extract a certain amount of lithium. So 2 tanks will double that, 4 tanks will double that again. So when you want to scale your production, you're not building this giant plant. And some of our peers are going down that path. What you're doing is you're just making these modular systems. You're making more of these modular systems. And it's a very important differentiator for us, because for what that means in terms of us getting to commercial is when you're deploying a simple system, is that it's much simpler to build and therefore quicker and lower risk. And I'm going to talk about the resource, and I'm going to swing back to that slide because Kobe brought up a good point, and I want to sort of hone in on it a little bit. So we have 24 million tons of lithium in the ground here. You can see the new resource we outlined, and this is only a couple weeks old that we got this out to the market, is this orange area here on the right is the Bashaw district. You can see Calgary here. This pretty much sits in Airdrie. So for those who know Calgary geography, and spans all the way to Camrose. So that's 160 kilometers long. It's 40 kilometers wide on average and 200 meters thick on average. It is 59 cubic kilometers of brine contained in this aquifer. It is a literal ocean of brine, and it contains 74.5 or 75 milligrams per liter of lithium on average. So this is a huge, huge opportunity. This is a world-class, and when you look at it from a producer of fluids, and this is a really important point, from a producer of fluid standpoint, the Leduc aquifer is a world-class aquifer that has been producing oil since the 40s and is prolific to the point where when you rank it in the world for oil and gas producing aquifers, it sits in the top. And that is because of the ability for it to move fluids in and out of it. And that is what really sets for us why the project costs, why we're able to do this at 75 milligrams per liter. All of those things that make this project work are largely due to the quality of this aquifer. So when you look at our peers and they have slightly higher grades than us, we offset that grade with the production ability from this aquifer. And how that looks is that when it comes down to your cost to produce brine, it's relative to two things. One is, what is the value per unit? So how much lithium is in per unit of brine, per liter of brine, right, that you produce to the surface. And therefore that amount of lithium has a value. And the more lithium in it, the higher grade, the more value. But that's offset against the cost to produce that fluid to the surface. So if you have extremely high production costs to get that fluid to the surface, your grade inherently needs to be higher to get the same value out of it. And that's where E3's project sets apart, because we have a very low operating cost relative to peers to produce fluids from this aquifer. And that's all outlined in our preliminary economic assessment. You can have a look at that. Each well can produce about 3,300 cubic meters a day. And so that details how much capital you're required to drill the wells. That details how many pumps you need, and the pressure of the aquifer is 1,500 kPa. And what that tells you is that it's under extreme pressure, so it flows up almost about 1,000 meters to the top of the well. So it flows up 1,500 meters, which means you only have to lift it 1,000 meters, not the full 2.5 kilometers. So all of those fundamentals come together. And when you add on top of it an extraction technology that at 75 milligrams per liter it enables you to get 95% recovery, means you're getting the majority of the value out of each liter of brine. You're able to extract that value. So now you have cheaper production rates and high recoveries. And so that's how we accomplish extremely valuable project at 75 milligrams per liter. And keep in mind that because of the size of this, we can make one 20,000 ton plant work. We can make 200,000 tons of plants work as we grow and expand. So I think for us, the blue sky potential for E3 is to be one of the largest lithium producers on the planet. And when you look at the jurisdiction of this, and I think this risk really doesn't come to play until you're at the final stages of development. You're out there talking to the government to apply for your permits to build your facility, build your mine if you're mining, drill your wells if you're brines, and get this project into operation. And so for us, in December of last year, our energy minister, Minister Sonia Savage, proposed Bill 82 that got passed. Bill 82 provides the regulatory authority for lithium, which minerals from brines is technically what it was, to the Alberta Energy Regulator. Those are the folks that regulate oil and gas. Regulate oil and gas. So what that means is that they have a 60-year history in Alberta of in this area specifically, of permitting wells and facilities for the exact same operation that we plan to do. We plan to operate, like I mentioned, like oil and gas. So that's a huge advantage for us. Permitting is a big risk. Having a good social license is really important. When you talk ESG, S is social. You want to have a strong social license, a good relationship with your local landowners. Our landowners are farmers. They get paid to have this infrastructure in their fields. They can farm around it. It's usually about a 5 by 5 meter piece of land they lose. They farm around it. This is on a well basis. And so they don't lose very much of their farm to have a well, and they get paid a little bit of money to have that well sit in their land. And so for what that means for us as well is that there's a symbiotic relationship that's been developed with the landowners in Alberta that has a very strong, well-defined history and a very strong system that the government regulates to make sure that the landowners are compensated adequately for companies like us. And that system has been garnered for a long time. The other piece of this is the workforce. Alberta has a very strong workforce. The drill rig that's currently operating on our site right now and putting the well in, came off an oil and gas project. It will go back to an oil and gas project. The drillers drove to their site from their homes. This is not a remote fly camp that will be put in when we're commercial operations. People will be driving to their homes every day at the end of the day. They will not have to be fly in, fly out. So you look at that on an operating basis, it just makes a lot more sense. I'm just going to skip through this a little bit. So the ESG side I mentioned is obviously a quite important piece. DLE, direct extraction methodologies, are inherently, in terms of land and water, a much more sustainable way to develop a project. We use less than 3% of the footprint of land. And we also don't interact with the freshwater aquifers, which is a big problem with mining and salars. So we have this really solid story to tell that we don't have to do any work to. It's just how we operate. The other piece of this is the carbon footprint. Using our PA as an example, the majority of our energy is going to be electricity. So if we have a zero carbon source of power, a near zero carbon source of power, we can get the project down to near zero carbon. And so we're working on that right now to find a low to no carbon source to get a net zero carbon lithium product to market, which is incredibly important for our customers that we are talking to. I think this is what excites me the most, and I'll just wrap this presentation up so we can get to questions. Where we are right now is a really good pivot point for the company in terms of our development to the next level. So we are going, and we're in the middle of it. And I talked about this, I think, last time, that we're on the precipice of a big paradigm shift, and now we're in the middle of that. So we're drilling these wells, which are fundamental to get an M&I resource out. The pre-feasibility we're working on will get us to a reserve. So a reserve, the first DLE brine reserve in North America, we hope to have out next year. But the foundation of that is obviously the M&I upgrade, which we're working on with these wells. The pilot is the other big piece. We've been wanting to pilot this for a very long time, at least a couple of years. We're very excited that that is being designed right now. There was an announcement that went out today talking about where we're at with the sorbent production, which is the two pieces. You need the machine and you need the sorbent. We're commercializing the sorbent manufacturing, which means we're going to companies that know how to manufacture this type of material, and they're manufacturing it for us, which means that we can make it at commercial levels, which means that not only can we use it for the pilot, but we also have it ready for the commercial plant. And then, of course, this final product is that conversion into a lithium hydroxide, which is what we plan to do for the first plant at least. And so working through that flow sheet right now with vendors who know how to do it. It's a commonplace process in the lithium industry. We're not going to be reinventing the wheel on the downstream processing into the final product. So I've talked a little bit about 2022. So we're going to have some hydroxide hopefully up by the end of the year. We're drilling these wells, aiming for M&I upgrade early next year, and the pilot plant is in design and build phase. Next year, we'll be operating that pilot plant. We'll be upgrading our resources, completing the pre-feasibility study. That'll culminate somewhere in the middle to Q3 of 2023. And then we move into the commercialization phase. So then we sanction the project. We start the detailed engineering design. We start the permitting because now we know where the wells are going to be and the facility is going to be. And then we start the project finance, obviously, that we need to cash $600 million to build this thing. And then we put into construction, hopefully 2025 to 2026. So, and looking at that project finance is obviously quite a ways out yet for us, but I think it's important that we always have our eye on it because it's a big number. And strategic partnerships is how we're tackling that strategically right now. And Imperial, obviously, a big piece of that, moving that forward. So a little bit on our cap structure, we're about 60 million shares on issue, and we're trading about 250 today, which puts about a 150 million Canadian market cap. I think that we're on the verge of major growth here as a company, with all of the things that we have in place, and we chart out where our peers have garnered value. Keep in mind, most of our direct peers are over $1 billion of value right now, market cap wise, and where they achieve that value are strategic relationships and piloting. So we're very excited to see that those things being worked on and accomplished, obviously, with Imperial. So I'm just going to briefly talk on the Pure Lithium. I've talked about Imperial. So Pure Lithium is a company that makes lithium metal, and they also make batteries with that metal. They took our concentrate, they produced it into a lithium metal, and then they made that into a pouch cell battery, and they cycled it. and they got great results. And so we signed an MOU with them to advance that research. So we're sending them our concentrate now on a regular basis for them to develop the process and understanding the economics. Our goal here is to be able to offer a suite of products. And I believe that the future battery technologies will be lithium metal, either solid state or just a lithium metal anode. And right now they're not commercial. I think 2026, based on the industry and based on what I'm seeing, there's a couple companies that are saying that 2026 they'll have a commercial battery. It's something that you could buy as a car company and put in your car, which obviously takes a lot of work to qualify. So 2026. So for us, this is like phase 2, bringing metal into the production line. But something very exciting, because I believe that lithium metal will be the future battery. So we want to have a good partner, and Imperial Lithium is certainly that. Excellent. So that wraps it up, Kobe, and hopefully we can have some questions.
There's a lot of questions. So thanks, Chris, for the very informative presentation, and thanks for your taste and style, I must say.
Anytime.
And yeah, we'll now start with the Q&A portion of the webinar. And just a reminder to everyone on the line that you can type your questions into the chat box at any time. There's a lot to cover here, so I'll try and be quick here. And you did answer some of them in the latter part of your presentation, but it never hurts to reiterate. So Let's start from the top, work our way down. Chris, tell us the story of how E3 came to be. How did you first learn of Alberta's lithium potential?
We were looking around for lithium in 2014. We saw the market. We saw the small size of the lithium market, and the batteries, moving. And it didn't take a lot of math to realize that there's going to be a shortage. We just saw an opportunity. So we started to look for lithium projects. We were in Nevada, we were in Australia, we were in Argentina, Chile, looking at different opportunities. And we came across this. There was a company that had started this in 2010, and they didn't have a DLE technology. And so they didn't last very long, unfortunately. And they hold the ground that's now up north of us. So that area was held by them still at that point in time. But what we realized is that the lithium was in the Leduc everywhere. And then if you had any background in Alberta geology, which we did, you realize that there was this whole swath of the Leduc aquifer south of Edmonton that no one had ever looked at before. So there's only a couple of permits in it. So we went and staked the whole thing. And then we started testing it and there's production, oil and gas production. So we started testing that production and found lithium in every single well that we tested. Averaging, and the spread, the spread between high and low results are very tight in this aquifer. So very consistent data, which enabled us to put these resources together.
Great. So, and you guys really have first mover advantage compared to lots of the other lithium petrobrine companies popping up, in the sense that you have the DLE tech. So most of your competition is focused solely on the resource development, whereas you're also focusing on the technology. So, why develop your DLE tech in-house as opposed to relying on a third party like what your competition is doing?
Yeah, I mean, everyone has to keep in mind that there is no commercial DLE projects out there. We believe ours is somewhere in the TRL level 6, TRL being technology readiness level. So it's a way to rank how advanced your technology is, 10 being it's commercially being used. So we're sort of at a 6 right now. The pilot puts it at a 7 to 8. And then once the pilot's completely wrapped up and done and we have the results and it's working, that's 9. And then you build it and it's 10 into commercial. So we're sitting 6 here just before we start the pilot. The most advanced DLE technology out there is a 7. So we're in that realm, that ballpark of other companies. And we started this not because we necessarily wanted to be a technology company at the very beginning, but because there was a necessity. There wasn't something available on the market in 2016 when we started looking at the technology to build this project. The landscape is certainly different now. There are a couple other ones that I believe have the legs. They are also, some of them generally 4 to 5 TRL levels. So they're still being advanced and getting to closer and closer, which is great. All these things, the more, and this is how I feel about Alberta and Western Canada's lithium resources, the more people that are proving this and developing this, the more confidence the market has to invest in it is better for everybody. So we welcome some healthy competition. Again, we have our resources locked down. We have our technology. So we're not really too worried about in terms of competitor analysis. We're not really worried about the noise around us from competition side of things. But from the standpoint of why we did technology, it was simply a necessity at the time.
Gotcha. And since then, have you looked at other technologies?
Yeah, we keep our eye out on the competitive landscape for sure. Yeah.
Mm-hmm.
But again, none of them are if the next level is one notch above ours in terms of advancement. And I'm not what we have developed and the absorbent specifically that we have chosen to use and then to advance into what's proprietary now for us is different than the ones that the more advanced companies like Standard is probably in the DLE world one of the more advanced, right? They've been operating their pilot the longest of anyone out that I know of. And what they use, what absorbent they use is not something that we like and we don't use it. We have what we have has better, we believe anyway, and this is based on their PEA and the public information that they've shared. We believe we have better kinetics. And we're talking like order of magnitude. Like we can extract lithium in sort of the 5-minute range. We can get all the lithium out of it, and it's on a per liter basis, but you can get it all out in about 5 minutes. We're seeing our peers in the hours range. And that fundamentally comes down to the process they use. So we use a column design because we have the reaction kinetics, the speed. We can use a bigger piece of material, which means we can put it into a flow column. They're using these stir tank reactors, and it works. They use that because their material is very fine grained, so they can't use a flow column because the material you don't have a filter fine enough to keep the material in, and the dynamics of it don't work in a column. So you have to do these big stir tanks. So you stir it up and then you pour it out and then you stir it up again, you pour it out. So there's sort of like these big batches they have to do, whereas it's continuously flowing. And so the simplicity for us is that it's cheap. These things are cheap to build, these columns. They're easy to operate. They don't break down very often. They're very low risk to scale. Whereas the stir tank reactors, I think, are much more complicated. Therefore, they have inherent risks. They're more capital intensive, that sort of thing. So our material is the heart of that. It's why we can go to the flow column. But again, what I've seen in the market today, what we have and what we've developed still stands out from my perspective. And so we're still pushing it forward. Now, I will caveat that, like, if the best technology in the entire world showed up on our doorstep and we tested it and it worked way better than anything we'd ever seen, and the royalty was affordable and the economics balanced, that it was cheaper to use that than ours, we would consider it for sure. Because at the end of the day, the value is the lithium in the ground. Now, having a leading DLE technology means that the value is also in our technology. And we aim to look at that value in the future as well. But the biggest value that we hold right now is the 24 million tons of a highly valuable commodity. And so our goal at the end of the day is to get that out of the ground and make money on it. And so, we would look at it. But right now, from what we see, we're definitely in a good spot.
Yeah, no, well said. And I think just something to clarify to listeners on the line here is that, there's no one size fits all solution to DLE. What works at one person's brine might not work at another brine. So there's different types of DLE. You guys are using ion exchange. So tell us, what exactly is ion exchange? How does your DLE work? And what you mentioned that it's a sorbent material that makes it proprietary, and it was a great overview. Is your sorbent patented? And let's also touch on that ion exchange, because the process itself, as we mentioned, it's not proprietary. So what is ion exchange? Where else is it used? And is your sorbent material itself patented? Sorry for that. That was a lot of questions in one, but
so yeah. I'll do the one-on-one DLE one-on-one ion exchange, and then if I forget about the patent, you can ask me about that.
Okay.
Again, so in a flow column, like, take lithium out of the picture and you put in calcium if you have hard water, uranium. So I think those are probably some of the bigger applications. But ion exchange is used anywhere in the world where you want to remove a metal from a liquid, right? So uranium from an extracted source, salts, right? You can extract, if you have a solution mining, you can use ion exchange to extract the salts. If you have hard water in your basement, that's an ion exchange. Water softener is an ion exchange unit that takes calcium out. So ion exchange is used globally for all sorts of applications where you have a metal of interest, you want to remove it. So for us, our metal of interest is lithium. How the systems generally work is that you flow the brine through these columns, and they have a ramp up to in terms of like the extraction of lithium. So they ramp up over a very short amount of time till they reach peak extraction. So, sort of saturate the brine in the system, and it sort of reaches its maximum extraction capacity. And then it sits there as you flow the brine through it until it starts to fill up with lithium, right? And then as it starts to fill up, you see a decline, and then it drops away. And at that point in time, so that's lithium molecules effectively coming out of the brine. So the way you can measure that, and the way that we measure that, is that you're measuring the lithium concentration of your brine that's coming out the bottom of your tank. So you flow brine through the system, and initially there's a bit of lithium in it, and then the lithium disappears. There's no lithium in that brine, maybe 1 or 2 milligrams per liter in that brine for however long it flows while you're hitting up to your carrying capacity, and then you start to see the lithium show up again in the brine, and then that's when you stop the flow. And so the flow is dictated by the width of the column. In a column design, which is what we're chasing right now, it's just dictated by the width of the column. So the height dictates the capacity of your extraction, so how long a cycle can last. Your flow rate is dictated by the width of your column. So if you want more flow, you make it wider. And in the ion exchange world, to test it, you don't have to go to, like, we're looking at maybe around a meter wide column by 3 meters. That's sort of where we're at right now in terms of the design, and that will change over the next, say, 6 months as we get the pilot sort of running, because that data dictates the commercial design. But you don't have to go to a meter wide. You can go smaller than that, as long as the height is the same. Because if you make it wider, you just get more flow, but the dynamics of the system remain the same. And that's fundamental ion exchange. It's not lithium ion exchange. It's just common industry ion exchange understanding. So when we look at the process for us, when we strip off the lithium, it's the reverse. So instead of collecting lithium on, we strip the lithium off with our wash agent. We just change some of the chemistry of the wash agent so that it extracts lithium rather than repels it, which is what brine does. Basically, it's more prevalent on the material when it's in brine, but in our wash agent, it wants to be on the wash agent, not on the bead anymore, so it comes off the bead. We wash it through. The way that we concentrate is that we use less of the wash agent than the original brine that flowed through the system. So we basically run it for a shorter amount of time, but we still get all the lithium off. And you measure it the same way, right? It's just in reverse. So now you're seeing, as you wash it through, you start to see lithium pick up. Lithium concentrations pick up, hit a peak. It flows for a while, and then they start to just decline because now you have no more lithium on your material, and then you stop it, and then you flow the brine again. And so the material gets rejuvenated. That concentrate that you create now has all the lithium in it. It has very little other impurities because the material itself, we believe, isn't selective for anything else. So where you might see calcium or sodium come through the system is that it's surrounding the beads, or it's on the side of the tank, it's scaling, that sort of thing. And so you can add other processes like a wash to clean that up so that you have less impurities into your concentrate, which means you get a much higher pure concentrate. And that work is what the lab is doing right now, is optimizing that. So they're figuring it out, figuring out how long each cycle needs to go, what the washes need to look like, so you get the highest grade, lowest impurity concentrate you possibly can. And that's sort of the process optimization. When we say we're optimizing, that's what we're optimizing. So that's sort of a 101 on ion exchange, probably a bit more detailed than you were looking for, but happy to get into the weeds on it. In terms of patents, yeah, I mean, we have a intellectual property protection strategy, and some of that involves patenting. So we do patent. We have 2 patents that are public right now that you can just go Google patent and then type in E3 and it'll show up. The other stuff is under patent review as well. And then some stuff just never gets patented. Like there's certain know-how that you trade secret, you don't necessarily patent. And so there's a strategy that you deploy to determine what's what and what you want to actually patent and not patent and stuff like that. So certainly we keep it very well protected. I know there's a question on here about data protection. We take cybersecurity very seriously at E3. We have multiple layers of security and firewalls and redundancy and all of that sort of stuff to keep the data protected that comes in or that we generate at E3.
Yeah, no, I appreciate the long-winded answer. You know, I'm pretty sure you knocked off 5 of these questions in that, especially when you were talking about the impurities here. I know we
Trying to be efficient.
Had a question on that. Yeah. So while we're still on the topic of DLE, let's talk about today's press release. You had a third-party manufacturer, your proprietary sorbent. They produce 20 kilograms in a continuous run, and testing thus far shows that it performs just as well as what you can produce in-house. So why is this news important? What does it mean for your DLE in the longer term? And does it make it easier to license off your DLE, or at least your sorbent material, to other developers? Or is that something you want to keep close to your chest?
Yeah, I mean, keep in mind that this material, our lab here in Calgary, we have all the equipment to make it. We've been making it to all of our development testing. We announced in June of last year that we were sort of done R&D. That the sorbent that we had come up with, we were done trying to tinker with it. It was fine. And to be honest with you, that has been the case. We have done very little to change how we make the sorbent since June of last year. All we've been focused on is how it's going to work optimally in a column. And it took some time to build a column that was running in October. We've been testing it. And now what we want to do is that in a commercial environment, we're not going to have the lab guys make this material, right? We're going to have a facility on site that's going to be manufacturing this material for us when we need it. And so to do that, you have to go test equipment. And so we're killing 2 birds here with one stone. And because we need material in large quantities for the pilot, but we're not ready to build the commercial facility to make the material. So these are basically just technology equipment manufacturers. They manufacture equipment, they design and manufacture equipment, and they can do that for us in our commercial plant. In the meantime, they have this equipment in their facilities. And so we can give them the materials. We go down there, we work with them to show them how to make it, and they make it in big batches. And the 20 kilograms that we announced that we made is just a test batch. It's just to make sure that the process worked, and it worked great. We're able to make it with no major issues. And then we took it back to the lab, we tested it, and it actually worked a little bit better than the stuff that we make in-house. And that's not surprising, because when you're making it in a commercial system, there's a lot more efficiencies, because you have these it's basically a continuous process that makes it. So it's always spitting it out, which means 20 kilograms is a test, but the equipment can just run. You turn it on, it can just run and continuously make the sorbent itself. So in a commercial environment, we'll have that piece of equipment. This company, if we decide to select them, they will design it, they will build it for us, we will put it into our plant, and then we'll just turn it on and make our sorbent whenever we need it. In terms of the licensing side of things, it is the thing that is sort of, the company has a lot of goals of potentially licensing this. And in terms of, you're right, like each brine has its own potential characteristics. And we believe that the sorbent we've developed has a pretty broad range of brines that we can implement it on. So we do believe that it's advantageous to license it out to our peers that might be looking for it. And there's, as you mentioned, there's lots of resource companies with no tech out there. So we will feel comfortable doing that when we can produce it commercially. And so one of the big sort of pieces that we've sort of set for us before we license it out or start looking more seriously at licensing it out is that we know for sure that we can manufacture it by a third party. And the reason for that is actually more to do with the fact that we don't want to take focus away from what we're doing to get our project running. We don't, and investors need to understand that we're not a technology company, we're a resource company. We are producing lithium hydroxide. We're not a technology vendor. So the value for the company and the return to shareholders for that value is in the resource and in making the lithium products, not in licensing the technology. That will make revenue, but not nearly what producing a product will. So the focus, therefore, has always been on getting this project running. When the material can be manufactured by a third party, if we want to start working on licensing it, right? We then don't have to spend the time making it. We can just bring brine in, run it through the system and test it without a lot of our time taken away to do that sort of work. And so that's sort of our thought process on licensing. We haven't really been too aggressive at exploring licensing opportunities. We do talk to companies here and there about it, and we go through some of the details under non-disclosure, but we're not chasing licensing yet. But this fall, when we have that piece finalized and we're able to make this en masse commercially, that's probably going to change. So, but right now we're status quo. We're focused on our own project.
Great. And, I'll ask one more question on DLE and then we'll move on. But someone wants to know what proportion of your OPEX does DLE make?
So in the PA, the DLE OPEX was about $415 of the $3,600 per ton.
Okay.
So, and it's actually a good point too, because there's a trade-off with reactivity to cycle life in some respects, and I think for us, when you look at our economics and you look at this on a project level basis, the project cost, the operating cost for this project is pretty inelastic relative to the cost of the DLE. And that being that if you double the cost of the sorbent, right, for whatever reason, if it doubled, you get less cycle time or you need more of it or whatever, because there's a certain amount of sorbent you need per amount of lithium in a brine, right? And you can actually get higher recoveries if you use more of it. And there's obviously it sort of plateaus after a certain point. So there's some metrics there that can cause us to spend less on sorbent or more on sorbent. And but a double number is a huge change to your project economics. If you doubled something, right, it means you're way off. And so if we ended up that big of an increase, which is completely unreasonable, a double number, you're still only at $4,000 per ton on a total cost operating basis, which means that it doesn't have a big impact to the economics. It's a blip on the radar to the economics of the project if we did something drastic like double the cost of the material. That from that perspective, it's a fairly, when it comes to the risk of the project, obviously people focus on it because it's not commercial. There's no DLE that's commercial yet today. And so, it's obviously a risk when there's new tech adds risk. But when it comes to the cost of the project, it's not in the risk category. It's not in the sensitivity that we're concerned about. Right.
So even if just to reiterate your point, even if you doubled what you expect it to cost, so if it costs twice as much as what you expect, you're still looking at being a top quartile producer in terms of cost.
We're still cheaper than our peers in DLE space on a per ton basis. Yeah.
Right. Okay, so with that, I think we got to talk about the Imperial deal. So now this is really the first time that the big oil has invested into lithium, at least for a company of Imperial size. It's about a $40 billion market cap company. I've heard others write this off, stating how that investment is just a drop in the bucket for Imperial. And while that might be true to a certain extent, we have to consider that Imperial has plenty of other options out there if they wanted to get their feet wet in lithium, and they chose to go with E3. Yeah. Further, this is much more than just an equity stake. It's more of a partnership. So I'm curious, what does this partnership truly mean for E3, and how does it actually change your plans going forward?
Yeah, I mean, there's a lot of synergies that drove this, but I will say that you're absolutely right. Like a company like Imperial, if they approached any of the lithium companies, I'm sure they all would have said, sure, of course we'll do a deal with Exxon Imperial, right? So, it is an important point. It also is about the relationship. And I have to be very truthful about, we've been talking to them since 2018, but we really started to develop a strong relationship with the team that we ended up doing this deal with in 2020. And they have a great group. For a big company, they have a great group of people. And the person that signed the other side of this agreement, we've been working with very closely, is a very thoughtful person, very adamant about looking at alternatives for growing the business at Imperial. And so we're very excited that their first stab in the lithium industry, a small investment, they're right, it's 6.3 million Canadian, 5 million US. That's what it was. And there's no changing that number. But the reality is that it means way more than the number they put in, right? In terms of meaningfulness to it, because they didn't make this decision lightly. It took 2 years to negotiate this deal, and most of that time was the higher ups at Exxon, at Imperial, and then the higher ups at Exxon, going through those gears, because it's an important move, I think, for the company. And so I guess for that perspective, like we're very excited to have them on board. When you look at it from a partnership perspective, it definitely forms a partnership, because the land that they hold, they own the mineral rights. It's right. So they don't have to lend those mineral rights to anyone. They own them specifically. And we own the crown rights around them. And so now we've consolidated this land package between the companies, which means that, this is going to progress as a partnership, regardless of what else happens. We are going to be progressing as a partnership through commercial operations with Exxon Imperial. And I think that's different than this isn't just a throw $6 million at this deal, as a charity, sort of green, we're going to do some green. It's not that. It's, in my mind, it's a lot bigger, my perspective, right? And of course, if you want the real answer, it is an important question for the folks at Exxon Imperial, and their contact is their investor relations media contact is on the news release. So you can reach out to them as well, and they have been in the news as well talking about this. And they had it on as their main primary news on their website for quite some time as well. So there's some pride there, I think, as well, in this deal. So,
aside from getting exposure to lithium, is there something more that's in it for Imperial?
Well, I mean, there is the building of a relationship, and with all of these big companies, when you have a small and a big, right, a David and Goliath situation, rarely do you see like a merger situation, right? Because it's not practical. So what we're looking at with them is building this long-term relationship, because if they want to develop lithium, they have to have technology. And now that we've sort of secured the option on this land, it brings them in as needing to work with us to develop this land specifically that the option surrounds, right, with us and our technology. So, that blocks competitors from maybe buying this land from Imperial. It also blocks Imperial from being a competitor for E3. Now they're working with us. So, I think for all of those reasons, I mean, it's hard to put, I don't want to put words in their mouth, because they are a very great partner to have on board. And they're here to help us out. They're here to work with us to get this. I mean, the end goal here is a commercial operation for lithium. That's the end goal. That is what we've been talking about. That is the reason that we did this deal, is to get lithium commercial in the province. But of course, it starts with the first step, which is a pilot. We need to get the technology pilot. So the $6 million basically pays for the pilot.
Great. And so we have some questions as to the actual pumping and reinjection process. So someone wants to know what happens to your waste, and I don't want to answer that for you, but you are planning on reinjecting any lithium void brine back into the aquifer. Is that correct?
Yeah. So the brine only stays on surface for an hour-ish. It comes up through the wells, through the pipeline into our facility, where we take the lithium out through the flow column and then right back into the ground.
And how far away are the reinjection wells compared to the production wells? In the PA, which I'll quote right now because that's what's public, is 15 kilometers between the production and injection gave 20 years at 20,000 tons a year. And effectively how this works is it's a sweep, right? So the further away your wells are, the more mine life you have. Right. So we arbitrarily picked the endpoint of the project at 20 years just because it was a PA, right? It's not an actual engineer design document. It's just a desktop study to understand what the economics might look like. So we arbitrarily picked 20 years. And then that 20 years drove how far away do the wells need to be to do this. That was 15 kilometers. The reality is we've got 160 kilometers, right? So that's why this can scale, right? Because that's just the small 20,000 ton first process. Great. Still plenty of questions here, and it's almost 3 o'clock. We're almost at an hour, Chris. Are you okay to keep going, or do you have something else?
Yeah, I probably about another 10 minutes. So
another 10 minutes. Okay. So I do want to touch on the resource more. We'll allocate 5 minutes to that. So as stated previously, this is one of the biggest lithium resources ever. You consolidated the Bashaw trend. You didn't really focus on the Rocky trend. So how does this resource update change your long-term development plans, and what's in store for the Rocky area?
Well, two things happened almost simultaneously that solidified where we're going to focus our first project, right? We always sort of looked at the Clearwater area, which we outlined on the map. It's still there. And when we do the pre-feas, it's going to be in that area. And we'll probably call it the Clearwater pre-feasibility study, because that's still, like, we have a district and then we have a project. So the Clearwater project still exists. It's probably where we're going to do the pre-feas. The two things that solidified that are the Bashaw district now is the focus point of the company. It's 23 million tons. It's more than enough for us to make a world-leading company on, right? So it certainly brings our focus directly to this resource and this area. And then obviously the Imperial agreement focuses on Clearwater as well, because that's where the joint lands are. That's where our consolidated land package exists. So for those two reasons, that's probably where we'll start the project. So, but we've always, I mean, we did the P on there, so we always believed that's where we'd start. But now that focus is pretty much solidified. The Rocky, I think we're going to do the same thing eventually. There's not the same sort of impetus out there. We're going to still work on it. We'll probably do the same thing with the resources that we did in Bashaw. Is sample the whole trend. Spend the time and energy to do that, and then consolidate the trend into a district, right? So then we'll have whatever it's called. We'll have that district, which the Rocky project will be now a part of that district. But it's not a focus for us. There's lots of talk about what to do with, in an M&A perspective, what to do with that, and one potential option is that you tie it into a bow with a license to the tech and a fully baked, full trend resource, and you can vend it off. The other piece is to keep it for us and just have it as another development zone, or maybe a joint venture with somebody and have them come in. So I think the real point here, more than anything, is that there's a lot of flexibility for E3 to continue to garner value, because we don't really need it for the next probably 30 years. Realistically, 20 to 30 years, we have enough to get going where we are. So when you look at it from the time value of money, it probably makes more sense to do something with it with a partner. But that hasn't been determined yet. It's just sort of like it's an obvious question, right? You asked it, everybody's looking at it going, well, now what are you gonna do with that? And I think it makes a lot of sense to sort of look at it from an M&A perspective at this point. But we're not, at this point in time, it's sitting there. It's not going anywhere. We're happy with it, and it's going to remain as is.
Gotcha. Okay, so let's briefly touch on the PEA. We have a question here on sour gas, and I remember on our site visit we passed by a sour gas treatment facility that was reportedly under capacity. So,
yeah. And
in your PEA, you have over 150 million in capex dedicated to having your own on-site sour gas facility.
Yeah.
So, if you could use someone else's facility, the capex savings could be huge.
Yeah.
So for the non-oil and gas investors on the line, what is sour gas and why do you need to treat it? And are there any other potential cost savings that could be made by using someone else's infrastructure?
Yeah, I mean, this is something we're working through right now as part of the pre-feasibility study. What is our requirement? So for H2S. So for the non-oil and gas folks, H2S is hydrogen sulfide. It's a gas that gets developed with the breakdown of hydrocarbons. It's in the aquifer, in some aquifers originally, and then H2S can develop, either increase or start when you have bacteria that gets put into the aquifer. So when humans come into an aquifer that's never been exposed to the surface like this one, and they start bringing brine up in an oil area. Now this is very specific to oil, right? So in the oil areas, you get H2S. And as you bring the brine and you separate the oil and you put the brine back down, you're introducing bacteria back into the aquifer. And that increases the H2S concentration, because it's the breaking down of the oil and gas by bacteria. So now you get biogenic H2S, and now you have more H2S. We took a very conservative approach because we were sampling on the oil and gas area because there were no wells available in where we actually planned to produce back in the day. So our H2S concentrations, we believe, are a lot higher than they will be where we actually produce because we're in the oil and gas area. We will know that definitively because we are currently sampling this aquifer where we plan to commercially produce from, which is outside the oil and gas leg, which, as I mentioned, is a very teeny portion. It just happens to be where we were sampling from. So now these wells will determine what the actual H2S is. We anticipate it, but we will demonstrate this with actual results here in the future. We anticipate it to be lower. And if it drops below a certain threshold, which we think it probably will, but we'll see what the results are. If it does drop below, then we don't need to process it ourselves. We can just separate it from the brine, put it in a pipe, and send it down to the facility that you saw when you were on the site tour, which is half owned by Imperial, half owned by another company. So they can treat it. And if we do that, we remove $150 million from the capital because we don't have to build the treatment facility and replace it with, I don't know, some other number. It's not going to be $0, but we have to build some, what they call a two-phase separator, which is what, when the water comes out of the ground at high pressure still from the aquifer, and you depressurize it rapidly in a big tank, big vessel, it's called a separator, and the gas comes off and the brine continues on, and you collect that gas, and that's where the H2S will end up, and you can put that to a process facility, and they'll handle it for you. So there is cost to have that vessel built, but it's not nearly what 150 million. So there will be CapEx savings, and probably significant CapEx savings to not have to build a process facility for H2S. So it has a huge implication, and it's another reason why we're drilling these wells, right? And it's a bit of it's taken me a bit of time to explain this, and so it's not something that it's an easy thing to outline to the market until we have the real answers. And then we will outline it to the market. But again, we can't talk about it in the economic standpoint until we have a pre-fees, right? Or we redo the PA. We have to have an economic document to talk about economics. So it will, the H2S concentration being lower will have a huge impact. And we've been incredibly conservative, assuming it's full right. H2S in this brine.
So with that, I think we have time for one or two more questions. So, I think it's important now to end this off and talk about your peers, your DLE peers, Standard Lithium, Lake Resources, Vulcan Energy. They're all trading at over $1 billion market cap. And of these, E3 has the biggest resource. Its anticipated development timeline really isn't that far off from its peers. Project economics are comparable, yet E3's market cap is hovering around 150 million. As of this morning, E3 is trading at a US dollar EV per ton LCE of 3.4 versus peers at 64, and a PNAV of 0.16 versus peers at 0.45. So, I have my own theories as to why the disconnect, but I'm curious about your explanation, Chris. And so why is there this valuation disconnect? What do you think investors are missing? And importantly, being undervalued is one thing, but what catalysts coming up are going to cause the biggest re-rating here?
Okay, so I think in the past, we've been discounted because of our grade, 75 milligrams per liter. And we tackled that again at the beginning. It's a concept that's not common in the mining world, right? A lot of mining investors are investors of E3 or investor in all of these stocks. And grade is king. Grade is always king. And here, grade is not king. Grade is like a good partnership with production. You know what I mean? So, but that's a concept that is not really well understood. And it takes a bit of time to explain it. So you're not getting that out to the retail investor very easily. But I think it's changing. I think people are getting wiser and wiser to DLE stories. And this is what happens as more of them come on, because there's more opportunity for people to read about them and see them and compare and contrast between different ones. And so then they get to be able, and companies get more advanced reports to the market, which have more of this type of detail in it. So all of this stuff is just a maturation of the industry. And as the industry matures, I think people will quickly realize that 75 at these production rates don't matter, because what really matters is what it costs. And we've outlined at a PA level what it costs, and we outline that again at the PFS level. It should bring that sort of solidification of belief into this. The other piece is, and I think the bigger impact is really the stage that the company's at. So when you look at from what really drove the value of other companies up to their sort of higher $1 billion market cap, One of the big things was piloting. The other big thing was strategic or some sort of offtake relationship. And so, we've got Imperial as a strategic relationship. And I think that the pilot is the pilot's coming. So I think that's going to have an impact on the value as well. And I think that it's like when you look at us relative to our peers, and you're probably better to analyze this and present it than we are. But if you look at our value relative to peers, and RK Equity does this every month, and he posts it, Howard Klein posts it. So you can actually just go to his RK Equity site and find it, or go to his Twitter feed and Howard Klein and find it, Lithium Ion Bull. They have their month over month relative changes, and you see that E3 is one of the top performers right now. The market is crap, right? The market is absolutely crappy right now, for lots of very big reasons, right? And so the soft market, E3 is still strongly performing. And I think that when the market returns, the macro market returns, I think you're going to see E3 start to catch up to our peers, because we are getting to those major milestones that our peers have created their value upon.
Yeah, that was a great way to end things there. And I couldn't agree more about grade not being king for DLE companies. I can go on about this. If there's anyone on the line that wants more of an explanation here, I'm happy to dive into the weeds there. You can contact myself. Chris, so thanks for joining us today. It's been a pleasure hosting you. And to our viewers, if you want to learn our thoughts on E3, as well as other companies that we watch, we publish all of our research on our website. It's free of charge. You can find my contact info there. A reminder that our next webinar will take place on August 2nd, when Managing Director David Talbot sits down with Valor Metals. Again, that's August 2nd, 2 p.m. Eastern, 11 a.m. Pacific. Thanks for tuning in, and have a great day.
Great. Thanks for having me.